welcome to our monthly webinar. My name is Andrea. I am with Minoria, and Minoria is here to help disadvantaged businesses with providing resources, solutions, and in providing any type of education. And for today, we're going to be working and assisting a lot of the contractors in trying to get them to understand bonding requirements when trying to work with larger contracts. But we do have some guest speakers, which I'm very excited about. Our guest speaker is Scott Salandi from Patriot Risk and Insurance Services, and Michael Faraj, Managing Member of Strategic Alliance Solutions. And they're specialists, specialize in bonding requirements, and I am pleased to have them explain all the requirements and the different types of bonds that contractors need to be able to get into next level of contracting. So, Scott, welcome and thank you for participating.
Excellent, excellent. Andrea, thank you very much for that great introduction. As she said, really the point of this presentation is just to give you a little bit of background on what bonds are, the different types of bonds, sort of why bonds are required, as our first slide here indicates, and to give you sort of some tips and tricks that I've learned along the way in my 30-year career as both a property casualty surety broker and as an underwriter. I've done lots of different types of contracting, underwriting opportunities from East Coast to West Coast, North and South, international and domestic. So I've seen a lot and done a lot. So there usually isn't a question out there that I can't answer. And if I can't, then I'm going to defer to my partner, Mr. Faraj. He's the smartest guy in the world. But as Andrea said, the first and foremost is why are bonds required? Really, this is, yeah.
And I'm sorry to interrupt. I did forget to talk a little bit about some of the indications in regards to the questions and how we're going to handle the questions after.
Sure. Yep.
So before we continue and to let you do your magic, I'm going to sort of explain to the public what we're going to do in regards of any questions afterwards. So on the poll on the bottom, you should have it on the bottom, questions and answers. We're going to wait until the presentation is finished to answer any questions. Make sure to write them down, and I'll make sure to include those answers in or those questions for either Scott or Michael to answer. Anything, we are going to go ahead and send you, all the participants and the registrants, a copy of the slides and a link to the video in case you want to go back and get some information off of that. All right, so I think I'm done. Go ahead, Scott. You can continue. Sorry about that.
Excellent, excellent. Thank you for that. Yeah, and if there's any reason to get a hold of us, we don't get a chance to answer any questions, just route everything obviously back to Andrea, and we'll do the best we can after the fact. Why are bonds required? There is a Miller Act, a federal Miller Act of 1935, that required all federally funded public works projects over 150,000 to be guaranteed. And that essentially is, a third-party guarantee. A fundamental difference from bonds and insurance is that when public funds are essentially the financing mechanism for public construction projects, the bond guarantees that those public funds are not going to be misappropriated or misused in any way, shape, or form. A lot of times the states will follow form with many different protocols and statutory obligations, and that's exactly what has happened here in the United States. They refer to it as Little Miller Act, which is essentially where the federal form, the Federal Miller Act of 1935, has been adopted by each of the states, all 50 states, and in many cases, some of the local counties or cities have enacted very similar statutes. And again, everything really started with the Miller Act of 1935. Next slide. The next question is, what is a surety bond? Everybody's heard about it. Some people hear about it and run screaming from the building. Other people have smart surety brokers like me on their team, or Andrea on the team, or folks like Mr. Farage, and they have an opportunity to sort of demystify the wonderful world of bonding. But essentially, there's three parties to a surety bond. There's the principal, that's you guys, that's all the contractors out there that are looking at contracts, looking at bid opportunities that have the word bid bond in them, have the word performance bond in them, payment bond in them. In some cases, you are required to provide a license bond to operate in the state of California, Construction License Board up in Sacramento. And so you are the primary entity that is essentially guaranteeing that a particular project is going to be completed. The obligee, not obligee, but obligee is the public entity. So that's the state of California, that's the city of Orange, county of LA, whatever that public entity happens to be. So essentially the principal is writing a surety bond to the obligee that says, we're going to complete the obligation according to contract terms and specs. The surety company is essentially a third-party guarantor. So they are kind of like, you think of them as almost like a co-signer, if you will. So if the principal can't, for whatever reason, complete their obligation to the public entity or to the obligee, the surety would step in the principal's shoes and assume that obligation through completion. It could be, if it's a payment bond, it could be some sort of a payment or a financial obligation. If it's a performance bond, it could be a performance obligation or an obligation to perform a particular contract. Next slide. So here's a little bit, we'll get into a little bit more detail about the actual types of bonds and the process, but I wanted to really just take a moment to sort of compare what you are probably more familiar with, which is an insurance contract versus a surety bond. And like I said, the biggest difference is it's a three-party instrument. You've got yourself, the surety company, and you have your beneficiary or the obligee. Insurance is just you and the insurance company. Think about insurance and banking are very similar. It's you and the bank. Insurance is you and the insurance company. There aren't any real guarantees that are between any of the other parties. Both obviously provide very solid risk transfer methods. I would never encourage you to not have adequate insurance. And in this case is where you're running into the need to require bonds. It's a method by which you can transfer, if you're a general contractor, you can transfer risk through a subcontractor, and you can also require those subcontractors to bond back to you, which gives you a risk transfer method and an opportunity to recover should there be any sort of a default down the road. Again, both regulated by the state Department of Insurance. Both are, their fees are charged for them. Insurance is basically a look back at your loss results, and then they determine from an actuarial basis what your premium will be moving forward for the particular coverage you've asked for. Surety bonds are a little different, as many of you may know already. You are essentially being pre-qualified, and you're paying a fee for that. There aren't necessarily charges for bid bonds per se, but it's quite a process and involves financial statements, tax returns, resumes, looking at contracts to make sure that the provisions in the contracts are suitable and are reasonable and are not too terribly onerous for small contractors to engage in. Bonds are project specific. Insurance is typically calendar year, January 1 to December 31, and it renews. Bonds don't typically renew, they run the duration of the project. The penal sum is essentially a policy limit. You may have a contract for $100,000 church building, or you have a $50,000 parking lot that needs to be repaved. The penal sum is essentially 100% of that contract value. Next slide. So these are the three driving elements of the bonding process. Really, there's almost a fourth and maybe even a fifth, depending on your circumstances. But really, the capital, which is essentially the money, the cash, the receivables, the underbillings, your any sort of property, PP&E, property and equipment, anything that you have inside the business. There is a certain element that also looks to, in the underwriting process, it looks to the personal capital that you have outside the company, but essentially the primary source of capital is what is retained within the business that you guys have all operated and opened. The second C, 3 C's of surety, is capacity. And that's essentially the capacity of management. Is this a one-man crew or one-woman business? Are there 2 partners? Is there a board of directors? Is there a director of risk management? What's the depth of the organization? How many project managers do we have? How many project estimators do we have? How many crews do we have? How much equipment do we have? What is the capacity of the organization, at which point, if you were to exceed that, would put an undue risk on the organization as a whole? And so that's an important part of the process, and the underwriting process is to demonstrate to a surety company, much like to a bank, that, hey, we have the capital to operate the business at these levels, the levels that we agreed to. We have the capacity, the depth of management, and we have the resources and the means and methods to perform for you, Mr. Surety Company. And lastly is the character. That's a big part of the construction world, quite frankly, and it's one that is no less important now than it was 100 years ago when the surety business actually kind of kick-started. And that's essentially your reputation, your integrity. What you say goes, and you need to stand behind your company if your name happens to be on the building. Sureties are not really interested in fly-by-night operations. They're really not interested in one bond and done kind of scenarios, or that last sort of aloha bond, if you will, but just give me the bond and I'll do the job. They're really interested in a long-term partnership. And that's where, character of the individual and character of the organization really does cause a significant concern for most underwriters. It's a people business, after all. It's not really a transactional relationship. And really the fourth C that's kind of missing here is the credit piece. Very, very important for owners of businesses to maintain and be good stewards of their own capital and their own personal credit. Bankruptcies happen, foreclosures happen, IRS problems happen, and that's just sort of a function of the business. As we were talking earlier, nothing ventured, nothing gained. Construction is a difficult business to be in, and I think next to being a restaurateur is probably one of the highest failure rate businesses out there. So I commend you for forging ahead, regardless of all the statistics that are definitely leaning in against us. But the personal credit is big, it's important. And if there are some hiccups out there, there are some strikes against you, just be very apparent, be full disclosure, be completely honest with your broker, with your creditors, and just explain to them what happened, why it happened, and how it's not going to happen, and sort of lessons learned from that kind of stuff. Because the public filing, the sureties and the bankers see everything. So don't think that just because you don't put it on an application, it's never going to come up and rear its ugly head. So just be mindful of that. And it's all about transparency in this type of a relationship. So next slide. So again, just getting back to the 3 C's of surety and getting a little bit more down in the weeds on this. What exactly, where can you look for your capital? How can you determine how much capital you have? What does your capital look like relative to other contractors in the market? And essentially, it starts with your financial statements. Hopefully, and I know we've got all different levels of attendees on this webinar today. Some may have QuickBooks. Some may have a legal pad where they write down how much money they have in the bank. Some may have compilation statements that their CPA puts together, or their sister-in-law or their brother-in-law puts together because they took accounting in college and they kind of understand it, or a husband or a wife. But it really starts with that financial statement. And Michael does a great job, and I know Andrea does as well, putting the building blocks together to get to some point where we have some reasonable place to start. And that's really, what this whole presentation is about, is giving you the concepts and explaining the process a little bit more. So it starts with a financial statement, whether that's a handwritten financial statement or it's a very pretty spiral bound, very expensive financial statement that your CPA put together and charges you $50,000 for. But that's really where it starts. And in that financial statement, the surety companies are looking at, what is the composition of the net worth, the retained earnings? Are we retaining profit? Are we just distributing everything out and we are creating a tax loss? What's the cash flow look like? Is it positive from operations? Is it negative from operations? If it's negative from operations, and I know COVID being what it is, it's certainly impacted a lot of my contractors' financial statements. But I know with a lot of the PPP money coming through, the cash flow has actually been flipped around, and it's been very positive for quite a few of them. So all different components of the financial statements, all different components of the cash flow net worth are reviewed, as part of the underwriting process. And last but not least is the indemnity. That's essentially the guarantee. In the wonderful world of surety, there is both a corporate guarantee, which is your corporate entity is signing the indemnity agreement with the surety company that basically says, Mr. Surety Company, if you ever have to step in on my behalf and you have to complete a project that I can't complete, you have to pay a debt that I can't pay for whatever reason, that I will reimburse you. Big difference between surety and insurance. There is no reimbursement requirement for insurance. You have insurance on a building that burns down, the insurance company pays a loss. They probably will cancel you, newsflash, and then you're going to have to try to find insurance from someone else. But there is no reimbursement effect there typically with most insurance policies. So you provide both corporate, and in most cases you will provide personal guarantees, both spouse, husband and wife, or really any owners over 10% of the corporation will typically be required to provide a personal guarantee. The premise is essentially, if you're not willing to stand behind your company, why should a surety stand in front of you to complete your obligations? So indemnity is a very important provision for all to understand. Next slide. And as I mentioned before, capacity, it's sort of the lifeblood of the organization. It's who do we have working for us? Do we have updated resumes on all of our key employees? Certainly the C-level executives, your CEOs, your CFOs, your chief risk officers, chief safety officers, controllers, those kind of folks. You're going to want to know, a little bit about those folks and where they've been and their extensive construction resumes. Even if it's very brief, a resume really does provide a lot of detail, in terms of where you were to this point. Contingency plans, depending on how large the organization is. I mean, certainly no one could have seen COVID coming and anticipated some of the financial impact that has caused many small businesses across the country and the world. But, having a plan to say, what happens if on this particular contract we need to go, buy 200,000 worth of material? Do we have a bank line in place? Do we have cash reserves to do that? Can we get that in advance from our equipment or material suppliers? How does that work? Banking is certainly part of that contingency plan, as is your insurance. Business plan, key component here. The business plan really helps owner sort of identify both short and long-term challenges to the business. Are we trying to expand into a marketplace? Are we trying to, create a new opportunity zone with, geographic challenges, or are we dealing with, lack of labor in a particular marketplace? Are we dealing with supply issues? Has everyone seen all the ships stacking up in Long Beach? We're having a hard time getting material to job sites. That's a constant issue that all contractors must face. So having a plan, and don't just write a plan and put it in the file drawer and never look at it again. It needs to be a living, breathing document every year, 2, 3 years. Update it, make sure it really makes sense in the current environment, because the environment is changing so fast. Next slide. And again, getting back to the character piece, very, very, very important. I think probably as much as capital and capacity is your character. Surety companies really like to obviously bond the best of class. It's a product, quite frankly, that is something that is so important. Your reputation needs to be as clean as it can be, and we understand things happen. We have financial hardships. We have jobs that go the wrong direction. They just want to make sure that it's a full disclosure, and you'll work as hard as you can to have any sort of issues resolved as quickly as possible. Relationship, again, this is a relationship business. The surety likes to bond good contractors. They like to bond humble contractors. They like to help people. It's just human nature. And I think this is one that, you just need to don't be afraid of reaching out to a surety company. Don't be afraid of having a relationship with an underwriter. They're absolutely people, good people. And it's just something that is super important in the relationship. References are also very, very important. Both subcontractors, if you're a general contractor, if you're a subcontractor, you've got suppliers and vendors, and you've also got general contractors as references. The surety companies really do like to do a deep dive on this. Again, they're looking for public information to see what legal things may be out there relating to your company, but they also want to talk to ABC Supply and XYZ general contractors and say, hey, they're good guys, they work really hard, or they're good gals, and they always complete the job. They're always doing everything they can to have a successful contract resolution, regardless of whose fault it is, because it's very easy to slip into that litigious nature of the business, because it's certainly there. A lot of people want to lawyer up and get into their corners and fight, and it really never ends up benefiting too many folks other than the attorneys. So, with all due respect to any attorneys who might be on the phone. Next slide. What's the role of the underwriter? Again, this is sort of your chief credit officer in the process, if you will. Much like a banker, they want to obviously look at all of the obligations that we are asking them to assume and to underwrite and to bond for us. Contractual obligations primarily is what they're concerned with. What are they having to basically take on in the event that we are unable to perform a contract? What type of payment obligations do they have in a contract? In some cases you've seen, and I've certainly seen over my career, you have, very onerous terms and conditions, very tight completion schedules, very significant liquidated damage provisions. In some cases, you have long-term and extended warranties. You've got efficiency guarantees, depending on what type of trade contractor you are. But essentially, the underwriter just wants to understand what it is we're asking them. So they typically will want to look at copies of a bonded contract. They want to look at copies of bond forms. And again, they're trying to review the obligations, determine the risk, and then provide a qualified principal to the owner that says, hey, you know what? ABC Construction is a fantastic concrete contractor, and they can do this contract. I'm confident. And here's the bond to perform and to pay all the obligations. Next slide. The underlying agreement. This is essentially, the bond. This is a copy. In some cases, your contracts will have performance and payment bonds, and in some cases, when it's a request for proposal, you actually have a bid bond guarantee. And so, when the surety asks for a copy of the contract and the bond forms, don't be terribly offended. They're really just trying to understand the obligation that they're actually agreeing to. The contract obviously will explain to them what the scope of services are required, but the bond forms are really where the rubber meets the road in terms of the legal perspective. Certainly, there are federal statutes, there are state statutes that dictate and drive many of the provisions in bond forms, just the overall relationship. But I have seen in many situations where you're a subcontractor to a general contractor, there are really no provisions that really speak to what can be in that subcontract for you or what can be in those bond forms for you. There are provisions that are going to be in the contract between the general contractor and the city of LA or the county of LA. That's all sort of required by state law, fairly standardized type stuff. And those bond obligations between a public entity and a general contractor are typically fairly standard. But once you get far away from the prime contract, that's when the water's a little muddied, so to speak. And I've seen some very onerous contracts And unfortunately, my clients will just sign those contracts because they need the work, and then they send it to me to get a bond. And that's when the real eye-opening experience occurs. So they're really looking at those contracts in detail, trying to make sure that they're fair and reasonable. That's what your attorney would tell you. If they are not fair and reasonable, and they're particularly onerous for a small company, like many on the phone today, it's something where they say, it's just not worth the risk. The gross profit that you may make, is not sufficient for this risk that you are going to have to just, basically swallow. So very important part of the conversation is to let them review your contracts, let them punch holes in those contracts for you, and let them kind of be the bad guys sometimes. Next slide. Functions of surety bonds. This is really, when you get right down into it, I'm not sure how many on the phone have actually had the opportunity to try to secure a bid bond or try to secure performance and payment bonds. It's a bit of a process, but what it really does is when you go through the process, it allows you to really open the competitive landscape for yourselves. When you can sort of say to someone, and a lot of my clients go through this process, and I tell them just, that first bond is always the most difficult to get. Once you get that first bond and the surety gets a little bit of a sense of who you are and what you are and where you've been, the next bond is easier, and so on and so forth, as long as we keep them up to date financially and we do our job, which is to finish every bonded contract, on time, on budget, with a favorable performance outcome. And then you move on to the next one. And you can start with that $5,000 bond. And I've done this with many, many clients that Mike and I share, where we start with that $50,000 contract or that $10,000 contract. And at the end of a 2 or 3 or 4 year relationship, we're talking about $5 and $6 and $7 million contracts. It's all about a process. And once you appreciate and understand that, it's a very nice differentiator for your business. But it expands the competitive bidding process. If you can bond, you have opportunities that you wouldn't have had before. And again, it's all about, it's your integrity sort of personified in an instrument that guarantees to a public entity, ABC Construction, we have a performance bond on these guys. They're going to be mindful. They know their surety's watching. They're going to perform. And ultimately, at the end of the day, it saves tax dollars because, again, credible, qualified, properly underwritten, and pre-qualified contractors are the ones who get a chance to bid. Typically, those flim-flam artists that come in the middle of the night and leave in the morning, they're not going to last long in this game because the surety process really flushes them out pretty quickly, and ultimately it protects taxpayer dollars. Again, getting back to what is a surety bond and how did they begin? They're basically it's a performance guarantee or a financial guarantee that protects publicly funded projects using tax dollars. Next slide. Some of the advantages of bonds. Again, this is, once you go through this process, you really have an opportunity to differentiate yourself, and you can tell owners and general contractors and subcontractors, if you're a second or third tier subcontractor, hey, you know what? We're bonded. Patriot is our bonding agent, and ABC Surety is our surety, and we can do jobs from $500,000 to $2 million or $50,000 to $250,000, and Mike's taking care of our financial statements, and he's got us all buttoned up, and everything is going great. But it really allows the cities and the counties to qualify you as a vendor. You've seen, and I don't know, again, it's a diverse audience here, but many cases you are pre-qualifying for school districts, you're pre-qualifying for various public entities to get into a database to be able to secure work, whether it's LAUSD, County of LA, City of LA. And this is a way and a mechanism for them to sort of qualify the contracting applicants and the vendors. So obviously gives them competitive pricing. It allows them to sort of track almost on a unit basis the different vendors and their capabilities. It guarantees obviously timely contract performance, quality product, and it gives them a recourse against you as the contractor, as the bonded principal, in the event that we cannot complete our obligation. And again, insulates the public officials from, the public procurement process where they are looking at a bid. They've got a bid bond that's there. They're going to give you the contract because you meet all the requirements. And, the understanding is that you're going to complete it and perform it and pay all of your obligations. And again, protects taxpayer dollars. Next slide. What's the difference between a surety bond and a letter of credit? A lot of folks are more familiar with the bank product that's been around for a lot longer than bonds have. Once you really step outside of the United States on an international scale, really letters of credit, certificates of deposit, those are a little more prevalently used just because there isn't a ton of case precedents outside the US with respect to the use of performance and payment bonds. But essentially, there are some similarities and some differences. Both are financial pre-qualification. Obviously, you're not going to get a letter of credit unless the bank thinks you're worthy of that. There is really no pre-qualification in terms of a capability or experience perspective. It's just, are you financially solvent? Do you qualify for a letter of credit? Yes or no. It doesn't speak to your performance at all. And again, there is no review of any of the contract documents or the bond forms. Obviously, a bond is a significantly different instrument than a letter of credit. Letter of credit, two-party instrument. Bond, three-party instrument. Letter of credit does not guarantee completion. The bond obviously does. That's your performance bond. There's no warranty period covered. Typically, in performance and payment bonds, in the performance bond, there is what they call an implied warranty. That's usually part of the premium you pay. Typically 12 months, but I've seen a lot of contracts as of late, and depending on which particular subcontract trade you might be in, roofers, solar, you may start looking at 3-year, 5-year, 10-year warranties, and those are kind of things that need to be discussed with your surety company. You can get coverage for those longer term warranties under certain bonds, but you really have to be financially viable and credible to get those kind of longer term warranties. Letter credits are cancelable. Bonds are not typically cancelable. Again, the performance is, your bond is canceled when the performance is done, contract is accepted. The payment bond exposure is completed when you pay all your bills under that particular bonded contract, and you've got all of those lien waivers and lien releases. You do have tax bonds, you do have license bonds, and some of those do have cancellation provisions, but typically the contract bonds we're talking about today are not typically cancelable. Letter of credit, 100% coverage. Sometimes it depends on if you have 100% letter of credit. Obviously, in most cases, 99.9% of cases I've seen over my career, we're dealing with 100% performance and payment bonds. $100,000 contract, $100,000 performance bond, $100,000 payment bond. It does not necessarily give you 200% of protection because the performance bond is guaranteeing performance. The payment bond is guaranteeing payment. It's two separate obligations, but they're really treated as a pair. Impact on bank line. Obviously, if you've got a $200,000 bank line and you have a $100,000 letter of credit outstanding on a particular bid, you're not going to be able to borrow that's outstanding on a particular bid. So while you certainly can post letters of credit and CDs for bids, and I've got clients that sometimes do that just based on time, I always encourage them to consider, provided we have enough time, to put a bid bond in place, because that requires no capital to be expended, and you can use that for the regular cash flow needs of your business. Next slide. I think we've seen this one. In the other direction. So just a lot of facts, a lot of talking. I'll kind of turn it over to my good partner there, Michael, to add a few pearls of wisdom. But your surety professional is your consultant, much like Michael and Joya. We sit around the table. We all have fairly big brains. We try to help, and what I really try to do is to qualify my principals and to manage their expectations, because you have to be, let's be honest, right? You have to be crazy to be in the construction business to begin with. You have to be crazier to stay in it. I've been in it for 30 years, and it's been an incredibly rewarding career. and I really do enjoy meeting new people, helping them out, explaining and demystifying the wonderful world of surety and banking and insurance and the law, because it all sort of comes together. And we really sit at the table with you, almost as your invisible board of directors, and help you be successful in the future. And ultimately to provide your own financial security, to help you, manage the pitfalls that invariably will occur at some point along the way, and help you navigate some of those bumpy, rough patches in the construction world. It's an incredible industry. I applaud you all for jumping in feet first, and I really look forward to any questions and the balance of the presentation. Thank you very much for your time.
Thank you, Scott, and thank you, Andrea, for putting this on. Before we go into the Q&A, we generally don't see losses that are driven by the performance of the work. It's generally the mismanagement of the funds or what we call payables or whatnot. And so having your books and your financial statements, it is key in something that we would generally call the totality of the information of your firm. So that's one big thing that construction companies really need to focus on. It's better business practice. Definitely on your larger projects, if you're in service or construction as a GC, your work in progress report is critical. It's generally what we call the heartbeat of the financial statement. We can see symptoms in terms of under or overbilling your clients, or not paying. So there's different metrics that we use, and so some of these items will come up in the questions. And again, thank you, Scott, and then Andrea, you can go ahead and go for the Q&A, and Scott and I can answer.
Thank you, Scott. Thank you, Michael. There is a few questions that we want to address. The first one is from Elias. Are there any minimum amounts to present the financial statements? So basically, is there a minimum amount in regards of being able to get bonded when they're barely starting and providing initially the financial statement?
Sure. Yeah, I'll take that one. It's, like I said early on, the 3 C's of surety, the fourth one that's really missing is the personal credit, or the credit of the owners. So we have many programs. Most of the major insurance companies have small contractor programs that they have that really are driven primarily upon the personal credit of the owners. So we can actually qualify contractors just starting out, or contractors have been in business for 5 or 6 years and don't really have that capital base just yet, based solely upon the personal credit score of the owner, which is why it's so important to maintain, be good stewards of your credit. So, for example, with a reasonable credit score of maybe 675 or 700, you can get up to $500,000 worth of surety credit. It's a little different than banking, but it's usually single job and an aggregate limit. So sometimes there's programs that will have 250,000 single job limit, 250,000 aggregate limit, or a 250, 500 or something like that. Now, if you happen to also have financial statements to provide, whether they're, QuickBooks, an internal, some other method, you can submit that in addition to, and sometimes we can actually qualify for, $500,000 to 750,000, maybe up to about $1 million. And then typically, you're going to need some kind of QuickBooks internal that balances, everything looks more traditional, an accrual statement or a cash basis statement. And that's a lot of where Mike comes in, or he can really scrub and scrutinize that data to put it together for us so that we can then make a presentation to a surety company. Obviously, the more surety credit you need, the more paperwork and the more detail you're going to need to provide. Very typical with a bank type relationship.
Thank you, Scott. I have a question from Pascual. Hi, everyone. Okay, this is my question. How long does it usually take to get qualified for bonding or increasing bonding?
Typically, when we have, like I said, we've got several programs with most of the major carriers, and it's a 2 to 3 page form. Has a little bit of information about the company, a little bit of information about the ownership, and that's we get a completed application back. It's usually 24, 48 hours. It's a fairly quick process because it's primarily limited to reviewing the personal credit of the owners. They do a quick check of the corporation to see if there's anything out there in the public records, any disparaging information or negative information. If there is, then we typically just have to deal with that and respond to that and kind of give a little bit of the background. But it's a fairly quick process. I'd say, on average, probably 48 hours.
This question is from Nettie. What is the maximum you can get bonded for a small contractor that is trying to go from residential in construction to city projects?
Right. Kind of embedded in one of those answers I just gave. It's really it really depends upon the personal credit of the owner as the sort of starting point. If the personal credit is a little wonky, we've got some hiccups in the immediate history, then we may be limited in terms of how quickly we can grow. But there's always a market for someone. A lot of ways where we can sort of compensate for a tougher credit situation, where we have a foreclosure, we have a bankruptcy. A lot of times, we have to start talking about collateral. There are markets out there that will take real estate as collateral. Some folks are fortunate enough to have a little bit of equity in their house. We do have surety companies that will take a second trust deed, even a third trust deed on a piece of, they prefer, in most cases, residential properties versus commercial office building type property as collateral. So if you've got decent credit, it's a fairly quick start. If you've got marginal credit, sometimes we have to sweeten the pot a little bit. We have to provide corporate financial statements that show how great we are, despite maybe a temporary shortfall on the personal credit side. Or we may have to show or agree to some reasonable amount of collateral that needs to be held during completion of the first contract. And then as we grow the business and we grow the relationship with the surety, the terms typically will soften, the collateral goes back, we get a little bit more surety credit, and we grow that relationship, much like you would a bank relationship, where you start off with just a business checking account, and then you have business, and you have an auto loan, and then you have a second truck, and then you have a third truck, and it just continues to kind of expand as time goes on. But specifically to that question, there really isn't a hindrance from someone coming from residential into the commercial market in terms of surety credit. Obviously, there really isn't a lot of bonding in the residential side. It's more public side. But as long as the credit was good on the residential side moving into the public works market, it shouldn't be too much of an issue. Obviously, from a contractual legal standpoint, big differences in terms of how you manage yourself from private negotiated to public work, prevailing wage, all the issues you have to deal with there. But the bonding is really not the stumbling point there.
Okay, great. Marcelino has a question similar to that, but in regards of the bonding, if there's any bonding assistance. How do we get about getting bonding assistance if we don't qualify for much amount compared to the project that they want to do?
Right. Like I said, it really starts and stops with personal credit, starts with the financial statements that we have on the corporate entity. If after we looked at the personal credit is not significant enough, if we've got financial statements that are not significant enough, and we don't really have any collateral to provide to the surety underwriter, then there are situations where we can have sort of third-party beneficiaries, excuse me, sort of a co-signer, if you will, that sometimes can sign indemnity agreements where they have the credit, they have the financial wherewithal to back. They may also have collateral to provide the situation and allow us to qualify for slightly larger surety programs than we currently have. But it's a process for sure, and I do see that from time to time where someone calls and says, "Hey, I need a $5 million bond." I've never had any bonding before. How do we do that? you have to qualify for it.
Right. Yeah. And I know that there's certain city and county projects or entities that help with some type of bonding assistance. In regards of Mauricio's question, it's a matter of connecting with those entities, and maybe if you can relate how that process goes, Scott. I'm not sure if you've gone through the process of trying to sort of connect both your qualification process of the bonding and the bonding assistance, these programs like the Los Angeles, the city of Los Angeles or LAX projects, how they have some type of bonding assistance for these contractors. How does that process work? Do you know?
I do. It is very, and I'm sure Mike's got some experience there too, and I'll just give my 2 cents. It is a process. It's fairly limited to those particular entities. So it's just for projects for LAX or just for projects for the city of LA. So if your view and your needs are that narrow, that's something that you can certainly explore. But where we're coming from is the much broader entire state, multiple states. Once you understand bonding, you are sort of in charge of your own destiny. But it works with surety companies participating in those programs, working with the applicants to get, bonding credit established and then moving forward.
Yeah, Scott, I'll piggyback on that. Yeah, generally those agencies or entities will have their own type of boot camp type of program where they go through qualifications of the contractor as it pertains to the scope or whatnot, and then their own surety process. What Scott's presenting and what we're presenting here as a whole, there are assistance programs that are ran through the U.S. Small Business Administration as a guaranteed program, and other ones. This is your general market of surety, and middle and upper tiers as your financial statements grow is where you're going to want to be. So I would focus on a traditional surety program, and if getting qualified means that looking into your business and making sure that your organizational and your operational items are in place along with your financial needs are taken care of, then that's generally the best way to start. So.
Thank you so much for your collaboration. Well, I think that's it in regards of any questions that our audience had. I do have a quick question because I know there's some small contractors out there that still don't know the difference, and they don't know if they have to deal with the same entity, the same surety or bonding company when it comes to bid bonds, the difference, right, between bid bonds, performance bonds, and
right.
To go explain that.
Absolutely. Yeah, the easiest definition or the easiest way to explain that is the bid bond is essentially a guarantee for the bid. All it essentially does is, if you've ever looked at a particular bid bond form, is it's a promise to contract. It's a promise to contract and then also provide the performance and payment bonds that are required per the contract. So, and that's why in some cases where my clients don't have enough time to go through the whole underwriting process, they can, in some cases, it's an alternate form of security, bid security. So it can be a cashier's check, it can be a letter of credit, or it can be a bid bond. And all it essentially does is it's more of a placeholder to a promise to contract and to provide their performance and payment bonds. So there typically is no charge for bid bonds. There is a charge that is incorporated into a bid for the performance and payment bonds. And that's the underwriting process that my contractors go through to say, all right, I have this $200,000 contract I want to bond, or I need to provide a bid bond for, how much is that going to cost me? Well, there isn't a charge for the bid bond per se, but if you're low bidder, and we have to provide that performance and payment bond for 200,000, it's going to cost you X dollars. And it's that cost of performance and payment bond that needs to go into your bid, just like concrete, rebar, roofing material, labor, overhead. It's a line item as part of your bid. It's a reimbursable expense. So once we go through the bid process and you are low bidder, then you have the obligation, obviously, to sign the contract and then issue the performance and payment bonds, typically within 10 to 15 business days after signing the contract or when the contract is awarded. And the performance bond is just what the name says. It is a bond that guarantees the performance of the contract. So the bonds themselves, think about them, they wrap around the contract. So that's why any surety underwriter wants to see the contract, because they want to understand what they're bonding. And then they want to look at the actual bond form to see what obligations they're actually signing up to stand behind. So the bid bond guarantees, hey, I'm going to provide a bid to you, Mr. Public Owner. If I'm low bidder, I'm going to sign the contract that's in the bid specs, and I'm going to provide you the performance bond that guarantees my performance of the contract. And I'm going to provide you a payment bond that guarantees I'm going to pay all of my subcontractors and suppliers and vendors that are downstream. So it provides payment protection for them under a bonded contract. So that's why I was saying earlier, once you become a bonded or a bondable contractor, you can really differentiate yourself from all the other guys to say, hey, come work for me. I'm a bonded contractor. I'm licensed, I'm bonded, I'm insured, and I'm a great firm. Come work for me, because a subcontractor has recourse, from their perspective against the general contractor that's bonded. Because if there's some sort of a payment dispute and there is a payment bond on the project, it protects you as a subcontractor because you can go against the general contractor's payment bond. It's another avenue of risk transfer essentially for you. So you want to work on bonded contracts. You want to be a bonded contractor. You want to, whenever you subcontract work to someone, you should think about incorporating bonds from them to you to protect yourself, much like you would on any other kind of risk transfer method. So that's, you asked me what time it was, and now you know how to build a watch. But bid bond guarantees the bid, guarantees you're going to get into the contract. Performance bond guarantees the performance of that contract, and a payment bond guarantees that all obligations associated with that particular contract will be satisfied and paid.
Perfect. Well explained.
Thank you. I try.
All right. So I think that's it. Like I mentioned before, we are gonna provide slides and videos and a video link to of this webinar. We do have our Minoria YouTube channel that you can refer to this webinar and others that you're welcome to go in and explore our library of webinars. Otherwise, thank you so much for your participation, Michael and Scott. I have all your information exposed, and we are going to share it with everybody else if in case they have any questions, okay?
Thank you.
All right.
Thank you very much.